Hello, this is Mariah Carter, your redheaded investor, and this is episode 2 of Radiate in Wealth with your redheaded investor. Now, episode 1, I talked about why I chose the word radiate. I also like alliteration, so radiate in wealth with your redheaded, R's, W, I don't know. It's because I lost a dear friend last year mysteriously, and she had chosen the word radiate as her word for the year of 2025. Well, it's been a year, and I wrote a note to her mom. Her mom's 82, and she's an artist. She specializes in making cute little cards and, I don't know, little portraits and whatnot. Anyway, I don't even know what I wrote her in a card. I was like crying while I did it, but she came back and sent me this. Isn't this beautiful? So she chose to put this word in art. And this is a frame I've had for a while from a dear friend, and I wasn't sure what to put in it, but it kind of works. So I'm going to put this behind me on my wall back here. Okay, so this is the episode where I talk about what did I invest in? Why do I call myself an investor, redheaded investor? So let's talk about that. I'm going to try and keep this at a minimum. So I'm going to go through what I invested in the last 3 years and like what it was, why I did it, and what did I learn from it. And I'm going to try and go on a high level. Now, the reason why I want to go over that is A, to validate, yes, I'm an investor. But B, I want to also say to you that I'm on a journey. I am not an expert. This is from my own experience. My whole goal with this channel is to work with those I know, like, and trust to bring them here on this channel and explain in understandable terms what these things are. So if you've got questions after this episode, just stay tuned because I'm going to have certain people come on and talk about each of these methods and probably new ones as well. Now, again, this is an authentic channel. I am not wearing any makeup. I'm wearing a ratty old sweatshirt I've had for years. Oh, there's my dog. She wants to say hi. The laundry's going off in the corner. My husband's doing laundry. And so I'm just going to be straight with you. So if you have any questions or comments, the only thing I ask is that if you're going to give anything helpful, I would like you to provide like a factual link to it. Really nothing biased. I want unbiased factual information to be shared. I will always fact check it myself. But if you want to have a one-on-one with me and talk about it, totally open to it. So again, I'm always learning. Okay, so there's that so far. I want to mention that, and I have my notes over here on the side. So, investments. We're 3 minutes in. Okay. So, the first thing I want to talk about is what is this term accredited investor. I'm going to say that slowly. An accredited investor. Accredited investor. So, that is the definition was defined, I believe, by the SEC. SEC stands for Securities and Exchange Commissions. They provide the rules and regulations for us to do this kind of stuff. They make sure the borrowers stay in line, the lenders stay in line, and what we all are focused on for that investment is a real investment and is not doing anything nefarious. So there's that. To be an accredited investor, I qualified because I had a high paying W-2 position. You can qualify for this by that, or and I don't want to call it a certification, but there's some sort of testing you can take. I've never really looked into it, but I should. But I hate tests, so I won't take them because I fail them all the time. But you can learn like the SEC stuff to then become an accredited investor. So it's not out of your reach based on salary alone, but here are the credentials. $200,000 as an individual, $300,000 annual, by the way, as a couple, or 5 million in assets. It's not all three of them, it's one of each of those that you can qualify for. So say you make $100,000 and your spouse makes $200,000, boom, you're an accredited investor. See what I mean? And the 5 million in assets does not include your primary home. And the reason why is because your primary home, unless you're renting out space, it is what we call a liability, just like your car. If your car is driven around to get from point A to point B and it makes you zero money, so you're not an Uber driver or Lyft, it is called a liability. So typically when you buy a car, they'll say the second you drive it off the lot, you lose value in that car. That is true unless you're renting it or using it for business. So that's what it means between liability and assets. We kind of want to cover that a little bit, throwing in the accredited investor. So hopefully that makes sense. Oh, and the other thing, an accredited investor gets access to really weird stuff. Well, not weird, but lucrative, more lucrative deals than anyone else. So that's a reason why you're an accredited investor. So you can get a higher rate of return. The types of deals that you invest in can be presented to you. So that is an accredited investor. But I will say this. Some people might come to you and say, oh, it's an amazing deal. Accredited investor, like you want to be in on this one. Do your due diligence. And I'm going to tell you that is a term I hate because I never really understood what that meant. Oh my gosh, I can't tell you how many people would say, oh, well, do your due diligence. Do that due diligence. I'm like, what does that mean? So we're going to be diving into that through this channel at some point. But I know what it means for me for due diligence, but I'm sure. I mean, I almost see it as like, like if you were newly dating somebody and like you have so much mistrust, you're just gonna Google sleuth the crap out of them, basically. Think of that as due diligence. You just want to make sure that person's really who they are. Think of it that way. Okay, so accredited investor, I think we got that down. Now, banknote investing. I have to say this is probably my favorite one so far that I've invested in. Banknotes, this is why I like it. It's so first of all, it's money that I don't need right now to operate my day to day. So I could invest. I don't know what the minimum would be, but you invest in what's a banknote. Now, one thing I'll say, mortgages can be banknotes and not all banknotes can be mortgages. I think that's how it goes. Yeah, something like that. But yeah, just know that there's a difference. And I don't know the nuances, so I definitely will be having somebody come on and talk about banknotes. But I like investing in them because it's like it could be a 2, 3 year hold or 30-year hold. You can get paid your principal and interest, which means principal meaning like, oh, I'm going to lend $10,000 over 2 years, say. Take $10,000 divided by 24 and then throw in your interest. Now, the interest on a good banknote, interest would be higher than a bank or a high yield savings account. So you're thinking between 7 and maybe 10%. That 10's a little high. But if you can get minimum 7, you're good. And you do that as annualized. And so you just kind of do the math. I could even do a math episode because that would help. Because some people just, I don't know, say these numbers and stuff, and it's like, what does that really mean? So we'll probably go through that one episode. Anyway, so I get like $200 a month on one of my banknotes, and it's like clockwork. And that's what I like about it because now I'm like, oh, I need some extra cash so I can pay down a little bit of that credit card I just charged on a birthday gift on or a trip I'm going to go on. Maybe that $200 over like 6 months will help pay for a vacation I want to go on, that kind of thing. And then I'm going to get my principal back, which means the money I initially invested. So I opted for just the interest payments. That's why it's so little, $200. You could get upwards. I mean, it depends on how much you put in there, but if you know how much your bills are every month, you could figure out mathematically how much you'd need to invest in banknotes to get that return back and just pay your bills with banknotes. Like that's the goal I want to get to. Like that might take me a few years to get to, but I like that idea because I don't own the asset. I guess I partially do because it is protected. And you don't have to worry about someone like paying the mortgage necessarily. You're going to get paid no matter what. Because they have protections in place on these. These are JV agreements, joint venture agreements you'll see. These are partnerships that you're making. So again, it's legal paperwork. If you're not used to legal jargon, either use AI to help you analyze that contract or go to an attorney. If you like investing, find yourself a good real estate attorney that can look at your contracts for you. Because let me tell you, these contracts, you'll see two different states sometimes listed on them. Like, this is authorized and ruled by the state of California, but your property's in Florida and everything else is in Florida. So why the heck is it California when the laws are different in California versus Florida? Sometimes that happens. And if you don't catch it, now you get a cluster and just hope the thing works out so you don't have to worry about that jargon stuff and the disconnects of the verbiage. I'm going to tell you right now that I can't tell you how much I've seen in paperwork that it gets goofy, but that's important. But I like banknotes. Okay, small business. Now, I mentioned small business lending because I did do that. I invested with someone that I'm very close friends with, but that was while I was in this journey in real estate investing. I also trusted this person because they know numbers, they're in the industry. So I was like, okay, I trust this person. I trust that they are going to run this as a business. Now, I like small business investing because, and I mentioned Cody Sanchez in my first episode. Cody Sanchez is like the queen of encouraging all of us to invest in small businesses. Small businesses are the foundation of this country. Even our forefathers from foreign countries come on over here, and what do? They start a small business. These big corporations just came later. We're corporate America for a reason because those small businesses grew and grew and grew and grew. And now they're these huge entities. And yes, there's an international reach, but you can get investors for that to help pay for the cost while you work out the numbers so that get paid that profit. And you can share that with the people who invested in the business. We have so many small businesses that need to be acquired that it's uncanny. So it is prime opportunity for us to do this. So anyway, I did that. They are paying me like clockwork. I love it. And it was for 2 years, I think. Yeah, 2 years. So, and I get my principal back. That was the most important thing. And that's what I want to talk about too is principal. Principal meaning the initial money I put in. And so say it was $20,000. It wasn't, but say it was $20,000. $20,000 2 years ago is not the same $20,000 now. So if you think about it, what gas prices were 2 years ago, food, college tuition, cars, that $20,000 now, I get less with that money. So I'm going to get that less money, valued money, and I'm going to turn around and put it in something else that has more value because I want to make that same $20,000 work for me. I'll be making probably about $14,000 on that small business. That's pretty good. So anyway, I'm excited about that. Okay, oil and gas. So my husband and I, we sold our house to move down south and we made a profit, but it wasn't like the capital gains. You'll hear that term too. Capital gains, I believe, is when you make like $250,000 difference from like what you paid for it and what you sell it for. I think that's what it is. And we did not, but we still made a good amount of money. And we were like, what do we do with this? So could we have used it to pay down credit card debt or something like that? We could have. But again, that value, I didn't want to just do that if I could do it with paycheck. You know what I mean? So let's make that money grow. So we invested in what's called oil and gas. That was an accredited investor investment opportunity. Now, I will say this, we get paid quarterly. The returns have not been like, yay. Although we didn't invest a whole heap ton of money, but it was a lot for us. But we don't get a big return on it. The biggest reason why we did it was we wanted to make the money grow, but also we didn't want to get taxed on it. So we basically put it in a tax deferred entity, which is oil and gas. So I think it was a good move for us on the tax strategy, but we now have to wait 5 years for that money to come back. And oh, by the way, when you see oil and gas in this country, they're not always drilling for just oil and gas. Sometimes they drill for water. there are certain states in this country that are dying for water. And so if the oil rigs that are pumping can be used to pump for water, that is a huge benefit to that state. So I know that part of our money is invested in one of those, I guess, oil rigs, but for water. And that makes me feel good because I always get confused with why our gas prices are so high, but we're pumping for gas here in this country, or oil and gas. But I don't know that nuances. I just know what I did. I put money in for 5 years. I get quarterly payment on it. It's nominal. And I know that we're pumping for water, which is pretty cool. That's what I think is my coolest part of it. And the tax deferment or tax write-off. I think it's a tax write-off, not a deferment, which is kind of cool. Okay. Another thing I've invested in was startups. This is when I got like excited about like, okay, where can I put my money? And so I invested in like these organizations that they'll spread the money out. So it's like a big pool of money, I guess, on a bunch of startups that they have certain qualifications for. I don't know the nuances. I was like, oh, hey, it's an opportunity, 5K in there. And I haven't seen anything. It's like 3 years. I'm pretty sure I just pissed away 5,000. Actually, it was 10. So I did 5,000 and 5,000 to startup entities. I mean, I'm thinking if one of the businesses does well, could I get like, yay? It's like the stock market kind of thing. I don't know. That was just 3 years ago. I've learned. So there's that one that I wouldn't probably do again. Okay, built for rent. I did do this. You'll hear real estate investors talk about how many doors they own. Now, realtors and real estate investors are different. Realtors are the ones that show houses or commercial property and they get a commission check. A real estate investor is someone who's investing money in that business or that house property. So when it sells, whatever profits from what was spent, they get a piece of it. It's also a term called real estate professional. And that means I think you're working 30 hours a week minimum doing real estate. I might be wrong on the 30 hours. I forget what it is, but that could be a tax category where you don't get taxed as much, I think. So there's that. So when I talk about these terms, realtor, real estate investor, and a real estate professional, and not all of them are the same. Sometimes they can be. But I did invest in a built for rent. This was a house that was built for just renters. It's a single family home. Now, I will say it was built for rent. So that means the workmanship is a little lackluster. It's not top notch. And it was in a lower class neighborhood, I guess, but it's providing a brand new home for someone who needs it and they can afford the rent. And I really appreciated that I could do that for someone. Now, I got it on a conventional loan, which means it was on my name and I have it listed as like a debt. And I wish I had done it as like a rental loan. I'm going to call it a rental loan, but there's a name for it. But I didn't. But the rate's really good. So I'm like, so I'm able to provide housing for someone, and I know who it is, and I'm happy that I was able to provide that. So, but I will say, it can be challenging because of when you buy a built for rent, the taxes on the real estate stays as like just the land. When the land is only valued at like say, I don't know, say hypothetically it was $40,000, it's different than a $200,000 house. So say it's $40,000 with no building on it, you're paying taxes on percentage of that land. Now, a year later, you've got a nice house on there, and now it's more valuable to the town. So they're gonna take, oh, the value of that house and the land, here's your new taxes. So my taxes went up. So I wasn't really making any money. I'm going to tell you this right now. The last 2 years, I was paying more just to cover the mortgage. So I would say 90% of the mortgage was covered by the renter. The rest of it was me. And I remember I mentioned to you that $20,000 that was valued like 2 years ago and it's worth less now. My house, same thing. So I thought I would have like a house with equity in it. Nope. What I paid for it is what I can maybe sell it for 3 years later. And that's across the country this year. Any real estate investor you know from 2025, unless it was a very special deal, most of us are hurting. We don't have equity in the properties we've invested in. If we invested in a property, that the next topic I'm going to cover is called a fix and flip, like those HGTV shows you see, things aren't selling because the market is very volatile. The rates are too high. There's a lot of people without jobs. They're looking for homes, but they can only rent, maybe, or they just can't move from where they are because of financial situations. So 2025 wasn't a great year. 2023, 2024 as an investor, very lucrative. Going to 2025, so I'm just going to throw that out there. Okay, fix and flips. So I had four that I did. And I'll tell you this, I lent money. It was rather large, but I lent it to someone I know, like, and trust. Know, like, and trust. It was for 30 days, it ended up being like 45 days, but I didn't care because I knew the person and we were made whole. And it was lovely. So then I was like, okay, here's my kickoff. So then that's down. So I got my money back with interest. Then I invested in another property. Well, Fix and Flipper was not in state. Got a contractor that took her for a ride. And then I executed my right to take it over. And with my business partner, we now own it as a renter. So we had to sink in more money to get it finished and then rented. So that's down. So now I own another door, by the way. And then the other two are on the market right now. One's on contract. It's third or fourth time, and I'm praying it sells by the end of the month. It's my biggest loan. And we'll see how that works out because there's late fees. Make sure your contracts have late fees on there. The other one, we had a miscommunication, I'm going to say, but now we're on the path where it's on the market and we have sunk in a little extra money, but we communicated very well with the partnership with the borrower and they were able to come to the table with some extra cash so we could finish this thing, but we need to sell it. And so there's that. So I'm still in the game. I still have property that I'm trying to sell and be made whole again. But I'll say this, due diligence comes into play with who you lend to nowadays, I would say. So I would say this, due diligence, again, a phrase I freaking hate. No one explained what it is. And if they did, I didn't see it. And I've been doing this for like 3 years now and still today I hear the term. But I know what it means for me, and we'll probably have a segment talking about what due diligence means. Just think of it this way. You met a new person, say you're single, and you're going to go date them, or company you're going to work for. You do your due diligence. Do they have anything negative said about them online? Like the stuff you would do for dating, or checking out a business. Anything negative about them, bankruptcy, anything like that. Like that's like due diligence. That's a piece of it. There's more to it when you're going to lend to somebody. I also want to encourage on both sides, think of it as a true business partnership. When you're going to be a lender, you are an active partner. However active it is, active. You are communicating. Communication is key. The second someone ghosts you and doesn't communicate, it's a red flag. I'm telling you right now, I don't care what side of the fence, borrower or lender, you don't respond, that's a problem. Okay, legally, I want you to get organized with your paperwork. Make sure all the documents you have, both parties have signed it, dated it, it's in a file, it's easy to find. And keep that for, just check on it periodically, like over the term that you have the loan out. Now, if you see anything that's a 6-month loan, if this person is a habitual 6-month flipper, that means they have your money month one. By month 3, the house is finished as a fix and flip. Month 4 is on the market. They get a deal and it takes 30 to 45 days to close. So that's your 6-month window. It should not be under construction for 6 months because that means you're in a 9-month term. And that means that that's where the late fees clauses should be. I just want to throw that out there. So your terms, that's where that due diligence comes in. If they're always flipping houses every 3-6 months, not that they have constant construction, That construction could be a whole year on that one project. I'm talking like they've got property they have built up, fixed up, and sold within 6 to 9 months habitually in the last year to 2 years. That's a person you want to invest with. Other than that, you're looking at a year, maybe 2 years out. I'm going to tell you that straight up. Things will always pivot and shift, but communicate, communicate, communicate. Always communicate. Okay, biggest plug. Never, and I mean never, invest your oh shit money. Your oh shit money is your oh shit money. That's not something you play around with. Put it in a high yield savings account where you're making like 3.5 to 4% CD, something to that nature that you can access it because it's an oh shit moment, not stuck in your stocks or anything like that where it's hard to get out of, but cash that you can use, but it's working for you in a bank. That's one thing. I do have an alternative for that plan, but I don't want to muddy the waters in this episode. But there is another thing that's far more lucrative than that, but I'm just going to throw that here right now, this one little step. Okay. Another thing I want to mention, partners can be friends and friends can be partners, but your business must remain business no matter what. That is like gentleman's handshake, girlfriends over some wine, coffee, whatever it is. Business is business, no emotions. It's facts. That's where I go right back to my first comment. If you're going to make a comment in here, unbiased facts. That's what I ask for. Okay, so this channel has me bringing people that I know, like, and trust, I've invested in, that can help explain these things that I've done in a very understandable manner that you can say, heck, I could do that. There's going to be other avenues, like people I've interviewed like 3 years ago that invested as little as $1 in something. So something that if you're like super scared about your money, that could be an option for you as well. Just test the waters and see where you feel comfortable. Oh, and I'm going to launch a newsletter to explain these episodes, but also anything that might be helpful. Businesses that I've partnered with, I can link you to them. And I'm looking for guests. I'm looking for partnerships. Would love to communicate and see if we can collaborate on this channel and what my goals are for this. And I guess how I'll leave it as this is, until next time, go radiate. Radiate your knowledge. Radiate your encouragement of others. And I'll see you in the next episode.